Never average into a losing trade. Stay tuned, traders. We're going to talk about that next. G'day traders, I'm Stacey Burke from Stacey Burke Trading, and today we're going to be talking about averaging into losing trades. Something you should never ever do. So Jesse Livermore talked about never ever buying into or selling more into a losing position. Paul Tudor Jones talks about it. Even my daughter Leah knows.
Losers average losers.
Losers average losers. Paul Tudor Jones had a sign above his desk that said losers average losers. I've copied off of him and done the same thing because, as you know, if you follow me for long enough, I've talked about blowing up small trading accounts, and inevitably every single time that I blew up a trading account or took a significant loss, it was when I averaged into a losing trade. And one of the biggest tips that I can give people, give traders, new traders, old traders, is like Warren Buffett talks about this. If you are in a losing position and you're going to try to average into that with more size, which inevitably is doubling, you're doubling down, that's a recipe for disaster. Even if you cover yourself and end up getting out at break even, it's almost, self-sabotaging psychology. You're training yourself to averaging into losing positions. You're already taking a loss, and then you're actually buying more or selling more when you're already losing money. And so in effect, in my own experience, what's happened is that those were actually the beginnings of false breaks, reversing strongly to the other sides of a range, or potentially a new breakout of a range. And in fact, if I'd hung on to those even longer, probably would have destroyed the entire trading account. So you get to the pain point, and if you have a technical level, like the thing about charting that most traders fail to realize is that they're not about predictability. They're about being able to define your risk and manage your risk. And as a retail trader, the number one thing you need to focus on is managing your risk, managing your downside. The upside, you can handle small wins, but you cannot handle large losses. And the most important thing as a retail trader is to and effectively manage your risk and ride out small losers, and train yourself to actually add into winning positions, so that you add to winning positions, not averaging into losing positions. Averaging into a position that's actually going against you is potentially, even if you inevitably get out, and most traders, I've done this, will tell themselves, if it gets back to break even, I'll cover the position. But the biggest thing you can do is to not take a new position into the market, because what will happen, in effect, at least even 50% of the time, is that position will continue to trend against you. And even if you think you've been around long enough that you can, average out of a loser and take a smaller loss, or potentially, maybe even squeak out a small profit by averaging in larger in a strong trend, it may work for you in the short term, but at some point, like Peter Brandt talks about this, your biggest drawdown is yet to come. You will face the mother of all losses at some point, and you will wake up in the morning or the next day, whatever your time frame is, and there'll be a gap against you potentially on one of those trades. Even though you may be profitable for the year, one of those trades could gap down against you or move strongly against you on a news factor, and you'll be stuck at the screen like a deer in the headlights and not knowing what to do, and you could be facing the mother of all losses. So never, ever, ever average into a losing position. Learn to cut your losses. Take the first loss. That's the one thing I talk about, switching to end-of-day trading. The big money is made on the longer time frames. The big money is made on compression of the larger time frames, weekly, monthly charts. Study Schaubacher, study Peter Brandt. I had an interesting comment this week on my channel. I just want to address this real quick. A gentleman talked about higher frequency of trades on shorter time frames, smaller risk, more potential for profits and more frequency of trades. Now let me clarify this. That's ridiculous. That's completely ridiculous. You don't understand risk management, whether you're on end of day or a 5-minute chart. If you're risking 1R, it doesn't matter if you're on a 5-minute chart or a daily chart. You should be aiming for an asymmetrical risk reward opportunity, so 3-to-1, 4-to-1, 5-to-1, 10-to-1 on those trade opportunities. And as far as frequency of trades go, that's completely false. Most traders can only manage 1 or 2 instruments at a time on day trading. They might filter out 7 or 8 or 9 or 10 charts to narrow it down to 1 or 2, but when they get into a live trade, they can only manage 1 or 2, especially the shorter the time frame they go. End of day trading, you can manage potentially 8 to 10 charts, and if you're really good, probably more than that. But you can scan up to 20 really reasonably high volume liquid instruments to look for your highest probability best A-trade setups and take maybe 5 or 6 trades a week, position trading with your risk predefined, and not even be on the screen, and be able to manage that based on the New York close, with profit targets in place or time stops or however you're trading that. But as far as frequency and number of trade opportunities, that's completely false. There's as many trade opportunities on end of day trading, including gold, silver, the metals, whatever you want to trade. But that's completely ignorant to think that there's less opportunities on end of day trading. And as far as your risk goes, if you're risking 1R, it doesn't matter what time frame you're on. So you really need to go back and study that, and really study the opportunities that exist on any time frame. So hopefully you got some value from today's video. But the biggest thing is that if you're on a shorter time frame and you're day trading, you really cannot manage, in especially the shorter the time frame you go, probably more than 1 to 2 instruments at a time. If you can, you're a superstar. If you haven't done so, go to my homepage, get my 7-step daily routine for high performance traders. Ritualize your daily routines. If you're not consistent, if you're not being able to be profitable, if you are, great, keep doing what you're doing. Doesn't matter what you're doing, what time frame you're on. If you're profitable, you're making money, keep doing it. If you're struggling, get back to basics, go to longer time frames, start setting goals, define a vision of the trader that you want to become, start journaling your trades, learn from your losers, do all the little things that are going to help you sharpen your edge and get better, and focus on constant progress and manage your downside. So stay disciplined, traders, stay focused. And my daughter Leah, anything you want to say before we close out?
Not sure.
Losers average losers.
Losers.
Never average into a losing trade. Have a great trading week, and may the markets go with you. Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.